Hey guys, this is Julie. Going to take a look at the VIX. We've got a 5-minute chart of the VIX on the screen. The pink line is the current day open, okay? So generally, in general out, general rules of thumb, if you are above the current open, the volatility is going to be going long. If you are below the current open, generally, the volatility is going to be going short. And you can go back through your chart and take a look at the VIX like this and get an idea to set up the day, whether you want to be going short vol or long vol. So if you're going short vol, that means that you want to be looking generally for long trades in the equity indexes because short volatility does not, you know, bode well for short positions that last. Those short positions that, the market can fall down a little bit, but they snap right back up. They refill much more than if you are long vol, where that vol can really take off, which we have not seen hardly at all. But this is the situation where you can lean on those long vol trades and try to go short for a longer distance. So all things equal in general, if you're below the open and moving down, you pretty much want to take shorts off the table, right? So get the ruler out and take a note of these daily levels. So the 1 day level is 79 ticks, right? So you can go from the current day open down and look for 79. You can see we broke 79 right here, right here. So you see how it initially gave you some support, came back to the super trend, and then it broke it. And so you were breaking your range to the downside, right? And so this is range expansion to the downside. And then they bought it back up dramatically at the close, and they were getting it back inside the range, right, for their spreads. So they trade spreads too. So they, I guess the market makers had to bring it back in to the range. And they interestingly did not break the weekly one of the NASDAQ. Um, when they did this, it was like threading a needle. Let me put up a chart and show you this real quick while I'm talking about it. Sorry, the computer loads a little bit slower when I'm recording. Give this a second to populate. Here we go. Um, Came all the way down, but did not break the weekly one, which was sitting on the daily one. The weekly one, daily one was sitting right there and acting for their spreads here. So it really is threading a needle when they get to these standard deviation levels. Here is a 3, daily 3 bounce, weekly 1, daily 1 holding the price. Came back, they brought the VIX back into the range for their spreads, I guess. Somebody had spreads going on pretty seriously, needed to get it back inside that daily range. And so that was a huge block trader or somebody that pushed it up at the last half hour of the session. Let's take a look at the ES real quick. Here's the ES. You can see that it did not get past its daily one either. So the daily one held the price. They were holding those ones which in itself is amazing. When you think about it, you're long vol, right? Because the VIX is short, and they are buying those bottom ones. So interesting. And they used it as, support resistance for their spreads. So definitely keep an eye on where you are for the daily range. You can trade to it. When you break it, you can still trade, but realize that you're trading outside the levels, and then look for those higher time frame support resistance areas. Because if you are going short vol, that means you're going long the underlying index, so they would be buying those bottom ones. Does that make sense? And that's what happened. Okay. And then, use the range to get an idea of where you are on a daily basis. You can look at the first standard deviation, the second, and the third. So, works pretty good to keep you in check of where you are. You can also put the JATS PT levels on the chart. So you can put a daily range up. And with tails. And let me put another one with the open. So calculating on the session open and close with tails. And let's see where this came in to play with the tail. So it went down to the second tail, 0.5. So let me show you something that's going to blow your mind. Why 0.5? What does that mean? Does it, 0.5, does it have a meaning? Yes. So this distribution here, you can see the two ones are right here. So this is the daily distribution on the session close, not the session open. Here's the open. And the open is right in the middle of the open distribution. But this tail went to the session close too. And what, significance is that? Well, let's first put a Fibonacci on here so that we can capture the middle of that range. So there we go. So if we take the ruler and we measure from that range to the 3, wait, this isn't right. Hang on. It's up here. That's that one. There we go, right there. So if we measure from here to here, which is, this is the 1, 2, 3 right there. And hang on. No, here it is, this one. So it is the bottom one. I apologize. Hard to see right there. 68. Right? So if we were to move this down make it 34, half of it, 0.5, 34, and then look for the 3, move it from the 3, so right there, that's the green line, right there, look, 0.5. So it was 0.5, half of the range going back to the mean. It's measured moves. That's what the algos trade. I'm trying to show you. So they took my distribution for the daily close and traded one half of that range outside the distribution to the tick and bounced it. And they took it back inside the 79 tick range from the open for their spreads to get it back inside. Right there, 79. Look at that. And that is how they they operate. So if you know the range that they're going to be trading in, um, putting the pieces together to know whether you're inside or outside that range, they do get to the point where they break the tail, then they're trading with it, right? So they would be trading with the short vol, um, going shorter and going to that 1 and 2 level potentially. Um, these levels are very algorithmic as far as the extensions that they take these trades to. And when they get to that point, they're just trading with it to a certain point, and even that outside level will eventually have them turn it around because that's where their outside spreads are. So they can roll the contract out and then they go to that first outside level. Let me see if we can, there we go. See, like right here. They would not, there was their call wall right there. They took it all the way to the top, rolled it back in. And that is your 3 to 3 range. So if you were to measure that, um, it's a 1. So you remember 0.5 was half of the mean to 3. Um, 1 is 1 time from the mean to 3. And there's actually a 2 that I use even outside. So I could put a 2 on top of this for like a really high level that probably never, ever would get hit. Unless you were in a clear COVID type environment where everybody was just calling and canceling their accounts. The dealers won't, break it to kill their own stuff. So like right here, let's put a 2 on top of this. So there's the 1, right? And so I'm going to add another instance of the indicator and change it to the 2, the 1.5 and 2. Let's see, do 1.25, 1.5. Well, here, let's start this. 1.25, 1.5, 1.75, and 2. And then let me add one for the open. Yeah, sorry about that. Here we go. All right, so here is the levels, and you'll see that on March, what day is that? 10th. Did I not get them on the chart? It's not printing. What's going on? Hmm. All right, we'll be that way. I don't understand that. That is odd. Let me just change this one to a 2, right? And see where this goes. More than one way to skin a cat. If it's not going to show me my indicator. I might need a bigger graphics card. It's odd. Now what's going on? Now I can't get any of them to print. Huh. Hang on a second. Okay, just so that you don't think that I'm crazy. Um, I didn't have it on visible. Crazy. Let's just fix this real quick and go back to that March. There it is. All right, so yes, everything's working. It was just user operator error. So let me go back to that March date. Here we go. May, April. And here we go. Look at that. Here's that March date. And it went up to my 2s and stopped. See what I mean, Jelly Bean? They know where my levels are, and they don't violate their own spreads. Look at that. Are you seeing that? Sorry about the technical difficulties. So that is your 2. And to prove it to you, I will make it real thick since I was having trouble with printing it. So there's the indicator. You can see the 2 is on the fib value 4. We'll go right here and make fib value PTB, B for below, PT for profit target, and PTA. So this is an A4, sorry. All right, A4, PTA, fib 4. Make that nice and thick. There we go. Do you see that? JATS PT measures volatility algorithmically according to standard deviations of ranges, and this is daily ranges, and it's really, really in step, I think, with the market. I would recommend using both the open and close because the algos do tend to trade to both of them. So let me put PTA for thick, thickest. Make this dash. So we can see the difference between the open and the close. There we go. So, you know, sell a call, buy a call with pretty good confidence that the dealer and the market makers are going to lean on that level because it's two times outside the distribution, and that's not where they want to take volatility. Outside of a Volapalooza type event. I mean, you can take this all the way up to Six Sigma, right? And you can control that. You can control how far you go out with this indicator. Look at this. They go right to these levels all the time. We don't know which one they're going to take it to. You have to use your other technical analysis to be able to tell, when a price is rolling over or continuing on a path, and that's why I use my simple um, super trend volatility bands as well as other methods, linear regression to turn, to get my linear regression channels and try to make trades inside of a volatility envelope. But one thing is for damn sure, I know where volatility range should be on a daily, weekly, 7-day, 9-day, 23-day, 30-day, 37-day basis. And so I can estimate, where the volatility is, in relation to where it started in that period of time and see how far along it's going to go on that path, as well as compare it to an option contract for that time period, right? So options use time expiration, just like I'm showing you that I measure time and range with my indicator. Okay, put those concepts together, get a path whether you're going long vol or short vol, know how far you're expected to go from that open, or you could put it from the opening. I mean, you could do it from a moving average, or you could put it from a VWAP on the ES. You can measure these ranges off of anything, anything. But I generally like to keep it the same way that the market makers will do it. So let me know if you have any questions. And I appreciate you guys. Invert this again, very easy to do. When you're making a strategy, you will want to flip this around for your ES strategy so that when you are, trading the ES, let me put that on the chart and show you. Here we go. You can convert however you use your logic to get an entry signal, whether you're going long ball or short ball. And I can control whether I take signals on long ball or short ball. Um, and go with the flow as much as possible instead of trading against it. And I think that will make all of our lives better. Um, so the last thing I want to mention to you is Earn2Trade does have a day left on it is special. So if you're thinking about trying to get funding, putting a strategy together like trading the ES with the VIX, you could come over to my website and check out their latest specials. I'll have them posted. And so right now through July 9th, so there's a day left through tomorrow, you can get 50% off of any new subscription. So coupon codes JATS, JATS, click on the Earn2Trade, and that will take you over to their website. You can take a look at what the requirements are. Within 15 days, you pass the requirements, and they will give you an offer letter for meeting that same challenge that you just completed, and potentially, have an opportunity to trade up to 16 contracts. So when that long vol is moving long directionally and reaching for those upper, you know, ones and twos, you'll know what to do. There's a few times a year, a month where that does happen. And if you have the strategy sitting there waiting, to fire off, if that threshold is met, that situation is happening, then that's when you want to jump into the market with both hands and feet. Otherwise, there's no way in hell that you should be trading 16 contracts on a normal low volatility day. Um, that's insane. But just having the flexibility to use some serious firepower when the market is moving, you know what I mean? You can have that, right? Otherwise, you can be trading, you know, one, two, three, four, five lots at any given time and do some, building, account building, waiting for your moments to shine, knowing when that long vol is coming in, and you have a strategy, reaching for those targets. And you don't have to trade to every high or low top tick. You can learn to trade to hit the base, right? You want base hits. You can go in there and use their progression ladder to scale in and scale out. Definitely, have a strategy in mind that you're not hitting the daily loss limit or your end of day drawdown, and close your positions on a regular basis if you're day trading. Uh, the volatility changes just because something happened 15 minutes ago in one manner of volatility zone does not mean that that's going to replicate itself the next hourly bar. Things change in the market all the time. You have to be extremely aware of what your volatility is doing, how it is behaving, where you are in the distribution. Once you break these ones, twos, and threes, you can see that the market reacts, whether it's breaking out of the range or coming back inside, back to the mean. So you have to be able to, figure this stuff out and then hopefully have these strategies ready. Am I trading back to the mean? I'm going to lower my position size, maybe put a one lot on. I know where I'm going and give it some flexibility to get there, right? Or do I want something far more strategic in mind and I can, create my own strategy using that? So I think together with these tools that we've got with NinjaTrader and Bloodhound to be able to throw these strategies together quickly and then have an outlet like Earn2Trade, get a strategy together, put it in the market, see if you can get an algo funded, and then use that same strategy, not change it, not discretionary trade, right? But have a dedicated strategy in the market that does one thing, right? You can say, this is my algo for trading for that long vol to the one or two, or this is my strategy going back to the mean, or this is my strategy leaving the 15-minute one going to the 30-minute one, or excuse me, the 30-minute two or three and the 60-minute two or three, right? One, two, or three, depending upon where you are. Um, if I'm above the one, I'm looking to go to the two, right? If I'm above the two, I'm looking to go to the three. That sort of thing. And on what time frame? Getting above the one on a weekly or monthly is a lot more favorable than getting above the one on a 15 minute. You know what I'm saying? You have more higher time frame participants going in your direction. The higher the time frame that you are breaking that one to go to the two. You have a lot more people invested in that, so you go with the flow. Go with the flow. And that's what I really like about trading. Go with the flow and then, putting all this together. So, one more day of this insanely good offer. You can go with any account size for 50,000 account for 85, and that gives you 6 contracts to trade with. That's plenty, in a normal world. But just having this flexibility of 16 contracts is something that I looking forward to being able to, use my firepower when I need it, and then, just think of the, opportunity if you're just going, to a 15-minute range in a high volatility um, situation. What does that look like? That, potentially, here's a 15-minute range. Um, you would want, to know where you are. Let me put this on put ES in here, or in, yeah, add ES. Come on, computer. Here we go. 525. So 525, four times, that's 21 ticks. At 12.50 a tick is $262.50. Times 16 is $4,200. So if you had 16 contracts and you had a good idea that you are in high volatility and you are in a 15-minute range, where am I going to be the next 15 minutes? You can potentially, translate that into cash. That's $4,200 for that type of situation. So you would have that available to you. Stretch that out, if you get in at the right place on a big breakout, you can go further than a 15-minute range. You could go to a 30-minute range, or a 60-minute range, and take that, $4,600 and turn it into, double it. You're going from 525 to 1075. So you're making, almost, nine or $10,000 at that point for just a very short amount of time. So that's why, having more contracts at the right time benefits you. Trying to do that on a day-to-day basis can do a lot of damage if you don't do it right, because the volatility is so back and forth during the day. You can get run over, you know, behind the eight ball, very quickly. If you try to do that, you're definitely wanting to employ something like that at the right time. But I love talking about strategies. I can't give you all of my code; it is proprietary. But definitely, you know, chat me up about using the tools to help you put your trade plan together, and using these volatility levels as guidelines to trade to. It's like having a football field. You know, do we want to hit the side of the barn, make it easy, profit target reached, profit target reached, profit target reached, or are you really trying to put a, one lot on and trade to the full, range for that time period? You can construct something doing anything that you would like. Infinite number of possibilities, right? All right, thanks, guys. I appreciate it. Sorry for the breakdown and putting the indicator on the chart. That was embarrassing, but yeah, it's all good. You can put these distributions out as far as you want them to go, and just realize that, here's the ES. They trade to these same ranges all the time. So there's that zero point 0.5 again. So that's one half of the range from the open to the close. Open to the three, rather. Open to the three, and then below the distribution right there. Look, see what I mean? It is so algorithmic. I have been showing you guys this many, many times, and that's because it is. Thank God for algos, right? Algorithmic. Talk to you later.